Let's ask Herald van der Linde, a very important global voice. He's head of Asia Equity Strategy at HSBC, joins us on this all-important day. Herald, great having you. Thanks for joining in. Do you reckon risk asset investors will have a chance to enjoy moments in the next 1 to 3 months post this Fed rate decision? Is this easing cycle going to be accompanied by upticks?
I think for the moment, yes. What you normally see is that the market has anticipated these rate cuts. And after the rate cuts, normally you have a couple of months of good performance as well. So if you say over the next 3 months, will risk assets do good? I suspect the answer is going to be yes. If you then go a little bit beyond that, say 6 to 12 months, then very often what we see is that markets are starting to come off because the very reason for the rate cuts is that things are slowing. And what we've seen in the past doesn't have to happen this time around, but what we've seen in the past, that markets after 6, 7 or 8 months after the initial rate cuts start to drift lower again because worries about growth starting to come through. So we'll have to see over time if that's going to happen again this time. But for the next 3 months, I think this is positive for risk assets.
Herald, good morning. Great to speak with you. Just to get a sense of what is the view now on emerging markets like India. From the Indian perspective, the rate cut paradigm shift becomes very, very important to understand where global flows are going. What would be the view?
Yeah, so the view is that these rate cuts will be positive for emerging market assets. And we like risk. Emerging markets is more risky than developed markets, so that's good. And what you're going to see is that because it doesn't make as much sense now to keep money in money market deposits anymore in the US, you want to put money somewhere else, and equities and Asian equities will fit into that as well. In addition to that, what we also see is that appetite for the Japanese market is cooling. So you see that money is coming out of Japan. That doesn't have to go into Asia, could be going somewhere else as well, but that's something to keep in mind as well. So there are two sort of dynamics that is good for Asian markets. And then the question is, of course, will they go to India? Now, the funny thing is that for global fund managers, they're underweight on India. That's got nothing to do with their view on India that has been negative or so. On the contrary, most of them are positive. It's just that they feel uncomfortable with the high valuations, and the local investors have bought up that market, right? So they've pushed the foreign investors out. So the question is, will they come back?
Sorry, just the point on India, if I can just ask a quick follow-up. If not India, then where else? I understand the valuations are uncomfortable, but for global money seeking a destination, what then is the alternative?
Yeah, that's the real problem here. You're absolutely right, because let's go around the region. Japan, we see the yen strengthening is no good for equities. In Taiwan, and to a lesser extent in Korea, the AI rally seems to fizzle out. So then you got, of course, India. China, the problem with China, of course, remains growth. And the appetite for China is not extremely high. So real good news got to come out of China in order to absorb their money. And that news is not there yet at this particular point in time. And then actually the other great story in the region is ASEAN, but ASEAN is small. So if we take that out of the equation, because it can't absorb the money that an India can, you're right, where else can it go? And that is the problem. That's, excuse me, that's exactly what you see in markets, that people struggle to buy more India because it's too expensive, but they are actually almost neutral in China because if you don't have much more in India, where else do you put that money? So you end up being neutral in China. That's right.
Herald, hi, it's also Samina joining in. And if you're buying India, and I know you've said this before, that India is where China was maybe 20 years ago. So the road ahead is looking very glorious for us. And everything seems to be coming together. You do like banks, from what I remember last. You also did say that while the balance sheets were strong, things could be slowing down. At the current juncture, with a rate cut in the US, an anticipated rate cut in India, which could help balance sheets for Indian banks, would you buy Indian banking names?
The short answer is yes. But I do see cracks starting to appear in the Indian story. We know the Indian story is great, GDP growth is great, and there's a lot of sort of formal retail takes market share of informal retail. I do see the first cracks to the Indian story appearing, but it's not something that is going to keep me awake at night, and also doesn't mean that I think that this is the time to exit that market or so. On the contrary. And those cracks appear in the banking system, to be honest, because you see that they struggle to keep the deposit because everybody's putting it in the stock market these days. So there's pressure on margins starting to come up, and delinquencies in some of the personal loans is picking up as well. But broadly speaking, you want to have banks or companies in general in India that have distribution capabilities. If there's one thing where India is unique as against China, you're right, a lot of things look like China 20 years ago, but where India is unique, you need to be able to distribute in India. That is one of the most difficult things to do. And banks and retailers and these sort of companies, they can. You get good distribution to a large part of the population that is growing and willing to spend more money on a mortgage or a car loan or maybe on cosmetics or something like that, then you're in a really good position in India.
Herald, would you tell investors sitting outside, including yourself, to add incremental capital to Indian markets right now? Or will you wait for a better time and opportunity, because the fear of missing out is also quite real for these markets?
Yeah. So basically what we tell people when it comes to India, you have to ignore the valuation for the moment. It is just, it is expensive, but the underlying momentum is good. And as you or your colleague just highlighted, what are the alternatives in the region? Where else do you really want to go? Yeah, Indonesia looks interesting. The Philippines look interesting. Those are smaller markets. Taiwan is struggling with AI. So that's a problem as well. So Korea is where people like to go. China is where some of them go, but it's really concentrated in a few stocks. And in India, you got a broader sectors, a broader selection of stocks where you can go to. It is expensive. We just have to digest that for the moment.
Herald, the question then therefore comes is how expensive can expensive become? Because some people argue that Nikkei, when it topped back in the last century, topped at 60 times multiples. We are still at 22 times.
Yeah, that's right. I think you've got to be careful what you wish for, because it sounds great if you can go to 60, but remember that the Nikkei then fell for 25 years thereafter. So then you got 25 years of bad market performance, right? Listen, I think if you trade as a market on 20 times, but you can deliver also about 20% earnings growth, and this year and next year, and maybe the year thereafter, as long as that visibility is there, I'm happy with those higher valuations. If we see that that visibility starts to disappear, or earnings disappointments come through, or we see that banks or certain consumer companies start to struggle with their businesses for whatever reason that may be, or we see other excesses in the market of people taking on way too much loans to put it into the stock market, which is something you got to be always really careful to do so, then I think you're getting to a situation whereby, hey, we got to be really careful here. That's exactly what happened in Japan. In 1987, 88, 89, the market was boom, 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 going up like in India. But eventually, when it started to come down, a lot of things started working in a negative reaction, right? People had used stock as a way to borrow some more money, and if the stock goes down, well, then you have to repay your money suddenly. So you got to sell even more stock to repay that money, and then the negative, the dynamics move into an opposite direction. Now, we're not there yet in India, and I hope we don't really get there. What you want is good growth, steady growth, visible growth, and a steady pickup in these markets.
By no means was I wishing for that 60 times, just making a point, trying to get a view.
I get your point.
Herald, we keep talking about this and we keep worrying about how China is doing, and the fact remains that metals are reeling under pressure. No matter what happens to the dollar, and you may see that weaker currency, positive commodities, all that play out, fact remains demand on ground is a huge problem. Do you not worry that this will play catch up?
That is a problem. We know it's a problem, and that's one of the reasons why demand for certain particular materials continues to be weak. China has got a growth issue, and that comes from the real estate market. The funny thing is, in China, in Hong Kong and Singapore, just to give you an idea, and in China, onshore China, it's the same. But in Hong Kong and Singapore itself, it's almost 2 trillion, and that's with a T, trillion US dollars, stand on the side. People hold it because they do not feel they can invest yet in China. The amount of money onshore in China that is held in deposits, where they cut a deposit rate in China gives you maybe 2.5% these days or something like that. But they keep enormous amounts of cash on there because they feel uncomfortable investing. It's exactly the opposite of what's happening in India at the moment. We need to see a catalyst for that money to be employed.
Okay.
I don't know what that catalyst could be, but there's a couple of things that could help. But at the moment, that's just clearly not the case.
Okay. Harold, just one final question. And this is about whenever you have good news, euphoria, excitement, we're definitely seeing that in Indian markets right now and globally as well. Then come those who are saying that there's going to be a big downfall. They're pulling out historical data, what happened in 2007. Just wondering if you're looking at any of that historical data at all, and are you buying into this sense of foreboding, or is it that people just don't want to enjoy what they're seeing?
No, I do look at the history a lot. I teach a class about it at a university in Hong Kong. But I think you got to also understand, for us to look at markets, we try to understand history in order to understand how things worked in the past, but it doesn't mean that's going to happen in the future. So we need to look at India equities on its own merits. Is growth good? Yes, it is good. Is it visible for the next 1 or 2 or 3 years? That means, are the underlying trends very easily identifiable and understandable? Yes, it is. Are the valuations excessive? Well, compared to the region, yes, but it's not, as your colleague just mentioned, it's nowhere close to where Japan was. So as long as these fundamentals are in place, this can continue. It's easy to call for a downturn because as long as you call, at some point in time, you'll be right. But I think that's the wrong attitude at the moment yet. Yes, there are cracks appearing, but it's not something I would say, hey, it's time to take money out of the market. So far, India looks good.
Okay, so far India looks good. Pleasure speaking with you, Harold van der Linde there. Always an interview with him leaves you with so many quotable quotes at the end of it, and this is no exception.